Good morning and welcome to the Monday Call, brought to you by NZ Funds. I'm Stefan Clark. Financial markets often have forces pulling prices in different directions, yet there are times when they move in unison. Investors who respond to changes early and actively position their portfolio can profit from these movements. This week, we will discuss 4 major market themes that are top of mind for global investors with Mark Brooks, Chief Investment Officer at NZ Funds. We will discuss why the outlook for hard commodities is increasingly favourable, especially for copper, what positive steps that the Chinese government is exploring to tackle its property issues and its sluggish economy, why United States-based companies increasing their capital expenditure is a sign of optimism, and why business activity in New Zealand is even weaker than the headlines suggest. Welcome, Mark. I'm really excited to get your perspectives on these highly topical subjects. Let's start with the bigger picture and how markets during COVID, the themes shaped the themes we're seeing today. And I think it's probably fair to say no one wants to talk about COVID anymore, but it's the long tail of its policy response continues. So take us through your thinking there, and then we'll dig into the 4 main topics.
Cool. Morning, everyone. Morning, Stefan. Yes, 4 years ago, COVID, so it's a long time and nobody really wants to talk about it too much now. But if you think about what happened there, it was a very uniform event for much of the Western world. And in that sense, yeah, people went into lockdown at broadly similar times. It lasted for different periods, but broadly it was very similar. And the response of governments was very similar in terms of, central banks cut interest rates. In New Zealand, we were down to 50 basis points. In the US, they were sort of similar level. So, that response was the same. Governments started spending. We had the wage subsidy relief here. In the US, they went even to the extent of sending people individual checks. It was $2,000 checks at one point. So there was that sort of stimulus and the effort to keep the economy going. And, the next step, clearly we all know, was, that drove a lot of demand, and there was a real shortage of assets or goods. And we got inflation out of the back of that. And, lo and behold, central banks rose interest rates massively. And in many respects, that has created still quite kept that synchronized activity pattern happening in many countries. And in terms of what we're seeing now, in terms of certainly some green shoots of growth in terms of corporate spending, that has a lot to do with what happened during the COVID period. Again, commodities has a lot to do with those green shoots of growth and the way the pattern of some of that post-COVID stuff happened. And then, China, to be fair, was a very different pattern. And they're going through some quite, their own GFC in many respects. And COVID is really, I suppose, only exacerbated some of those aspects there. So I think the main thing, again, though, is that sort of, that build-up of demand from the sugar burst ultimately. We're still seeing some of the ripples from that.
Okay. The outlook for commodities, especially copper, has been changing, and we hold within the NZ Funds portfolios for our clients commodities from time to time to benefit from changes in the dynamics there. Can you take us through why that market is changing and what are the underlying drivers that you're seeing?
Yeah, I might go back a little bit first. In terms of the core of our portfolios and really the core of all managed fund portfolios are really shares. And the power of shares are that they can be volatile, they're up and down, but they have an ability, and over time it's been shown that they drive quite a consistent level of return of that sort of 7 or 8%. And that is a reflection that they're highly diversified. You've got tens of thousands, hundreds of thousands of companies around the world that ultimately share markets are made up of. Coming back to commodities can deliver some very attractive returns, but by the nature of those markets being much more true supply and true demand driven, those returns can be, and I'll use this at a very long, quite a long horizon, can be quite episodic. So they can go for many years with having very average or, in fact, negative returns. But equally, they can have periods where, because of demand-supply balances, those returns can be very attractive and very strong, and importantly, quite differentiated or separated from returns in maybe more financial asset classes. So that's really, I suppose, the starting point that I'd like to sort of focus on. And then the next step is, if as part of that, we saw clearly the last probably super cycle we saw in commodities was when China entered the WTO, basically entered the global economy, and massively started to industrialize or sort of turbocharge their economy, and that required a massive amount of hard commodities. Over the last 10 years, 15 years, that's been on the downtrend. But as part of that process, there's been very little or almost non-existent new supply come on. Existing mines, especially in things like commodities, copper, have been used to a greater extent. They're working through that that supply, and demand's been growing. So if we sort of not wanting to focus on COVID, but even back as far as 2020, there was talk then that we may be on the cusp of another commodity super cycle. 4 years later, that discussion is still ongoing, but we're definitely seeing more and more of those steps towards that. And, copper really is ultimately, I suppose, sort of front and centre for that. And there's a couple of reasons. Well, I suppose at its simplest, one, 50% of global copper demand comes out of China. And China's been pretty depressed and going through, as I said, its own GFC because of property, etc. That may be changing. It's one of the themes we're going to talk about. The other one is really just that ongoing process of electrifying the world, and whether that is EVs, whether that is building out the grid, whether that is AI demand for electricity and the increase around there. All of it is just more and more demand that is going relative to a tighter market supply. So I think those are the key parts about copper. And in many respects, if we look at, say, financial markets, that price changes can impact and discourage demand for an asset, share, etc., more quickly. But in terms of commodity markets, those demand and supply differences are more real. And if people need to get hold of the commodity, to a degree, they become slightly price insensitive. So you can have much longer moves until you get to a period where there is true demand destruction.
And so when you think about, say, China and its consumption, is China's GFC, as you call it, because they're such a big exporter, right? They export so much of what they produce. Is that what's... is it the fact that they've held back on their internal infrastructure, or is it more that they're just exporting less because of trade issues, or is it Chinese consumption internally that's hampering demand from that side, or a combination?
Well, I think again, if we'd had the Chinese demand over the last couple of years, you would have seen a much larger demand supply imbalance. Because Chinese demand's been relatively muted, mainly through things like their sort of lack of building in their property market, and frankly a very depressed consumer in China, their demand has been less than expected. So we would have seen, I think, much earlier that sort of supply-demand imbalance. Ultimately, the rest of the world's demand has continued to catch up. Supply has been muted, and we've had examples. There's a large mine in Panama which was one of the the most recent, probably the only recent major mine that's sort of come online. And because of political issues within Panama, that has closed down for the time being. So you've had supply impacts, but you haven't had China there, so or not to the same degree. So that's really sort of kept the lid on it, and now you're starting to sort of see that pressure build. And from a supply standpoint, can you imagine trying to start a new mine in New Zealand now? I think optimistically, if it was ever to happen, it would be a 10-year plus project from design to consent to actually getting it working. That is the reality around the world, and so in order to bring on new supply, you've got to have basically prices much higher to incentivize that. And it's interesting, in the last sort of month or so, we've seen BHP bid for another business, mainly to get their copper assets. And that sort of is a sign that it's actually, they're saying prices are still at a point where it's cheaper to go and buy supply by buying another business than it is to start up a new mine. So, again, from, I suppose, the sort of, year 11, year 12 economics you do at school, that demand-supply imbalance is ultimately is what it comes back to. So for that reason, we have a very positive view on those sorts of commodities. Copper is probably the front and center because of that electricity need and the demand. But that's something that's playing out across other ones as well to a lesser degree. Probably the one where it's not is oil, and that seems a market where there is much more balance there.
So, I mean, if you think back, suppose you identified in 2020, 4 years ago, that there was a new super cycle on the horizon, and you're a mining company, you're still looking at many years before you can bring supply online.
Yeah,
and
at the moment, there's really, even in those 4 years, we have not seen any new mines announced. So we haven't had a price where people have said, actually, I know that going forward, I can assume X price, and I'll actually, it makes sense to go through that process of 10 years to do that.
And then at the same time, we've got, the need for electrification, as you call it, but within that, there's a whole bunch of things, EVs across the world, changing the way we deliver electricity and how we use it. So there's a huge amount of, on the demand side, if you believe those will play out in the way that many do, will underpin the price, I suppose.
Yeah, and again, it comes back to that sort of, I suppose those sort of simple economics, or not simple, but those basic economic concepts that, you need to get to a point in price where either it incentivizes new supply or you get true demand destruction. One example of that would be, people don't want to do it, but you can use aluminium for various parts of the electric cycle. It's just pretty unpleasant to do it, and generally the expectation is to do that, copper prices need to be about 4x aluminium prices. They're a long way from that at the moment.
And that's because the production process is much higher?
It's just not as efficient and harder to work with, etc. So,
and I guess the other one is, investment across the world is investors around the world are putting money behind recycling plants, and that might provide some supply, but it probably also has some demand underpinning it too, because there's a lot to bring those up to operation.
Yeah, and something you are actually seeing at the moment is that you have different phases of where you can get supply from. To a degree, the visible, this probably gets a bit too technical, but the visible copper supply out there hasn't really moved much over the last couple of months, even though demand supposedly has been very strong. What you're seeing is it's coming out of alternative forms, being what they call copper concentrate, which is a precursor, or actually out of scrap, as you say. So they're looking to other cheaper forms, but they're only, they only have a finite amount, at which point you go back to sort of the base, for want of a better word, and at that point we just continue to see, certainly pressure on prices higher.
So as an investor, if you want to get exposure to, and you believe that the copper price is going to move up over time, what are the ways you can do that?
Well, I suppose the two clear ways. One, you could choose to invest directly in the asset, which that's what NZ Funds typically does. So we buy copper futures or something like that, or gold futures or whatever the commodity is, and that's an easy way, fast way to do that. Another one is clearly to buy the shares of pure play businesses. So that would be miners, for example, or other businesses that benefit along that way. Or you could buy an ETF that has exposure to some aspects of those. But for us, usually it's about ultimately being able to purchase it directly in a highly liquid form, so that way we can add positions and take them off quickly. Because again, it is that I suppose where I started was for us within the growth portfolios, the key asset are shares, and we will always have an exposure to shares. Commodities can be a very helpful addition to that. They're a good diversifier, but they're not necessarily a long-term hold within the portfolio. So we need a way to better do that in a liquid and form which we can manage very easily.
So commodities are a big part of, I guess, the China story, and China coming online, if you will, over the 90s and early 2000s and before, but underpinned a lot of the price. Now, however, it's got the Chinese GFC, as you call it. Let's start with what's the issue that they're fundamentally facing, and then we'll move on to how's the government today looking to respond?
Yeah. I suppose in some respects, if you think about China and as a developing economy, how have people looked to invest their wealth and save? China doesn't have the social welfare framework that we do, so people do save a lot of money. They haven't been able to invest outside of China because of capital controls. And much like New Zealand, there has been probably a degree of almost distrust over things like financial products, etc. So they've wanted hard assets. So the typical asset allocation has been a lot of cash in the bank and owning property. And to the point where property a couple of years back was very expensive. Buying property in Shanghai or something like that was more expensive than here, for example. So from that point, the Chinese government it was a very planned approach to actually put pressure on that sector and start to effectively rotate the savings base, encourage the savings base to move out of that and look to, in many respects, probably create a bit of a soft landing. And they were concerned almost about what is happening, having an uncontrolled down cycle in property. I suppose what they have seen, given they very much it was an intended and a managed tightening of the property market and of the developers, etc. It's fair to say that's possibly gone further. It was definitely gone further than they would have liked. So, you've had a situation where basically property development businesses, some very large ones, have definitely been too leveraged and struggled and not been able to pay their debts. And that's morphed into a wider issue of a broad housing market downturn and an inability or just lack of demand to purchase new houses. And most of the Chinese, big chunk of the Chinese property market is new build related. So, buildings not getting finished because developers have gone bust, people not willing to buy stuff off the plans because they don't trust it, etc. So you've had, that sort of GFC issue where people have just gone, just not going to touch it, and that becomes a self-reinforcing process. What is interesting then is, you've had, if you sort of go back to COVID, China had a very long lockdown, people traditionally have saved a lot. They've continued to save throughout that process. In fact, they couldn't really spend it on much other than food, so they were forced to save. And now you've had a number of years ultimately where they've continued to save and not put it into things like, or they've been reticent to put it into things like housing. So you actually have this massive war chest of consumer spending or consumer cash sitting on the sidelines. And if we think about the process through post-COVID, one of the things that actually probably kept economies more resilient through that first phase of interest rate cycles was that actually most people had cash in the bank. That was the case in New Zealand. Savings rates were pretty high. Certainly in the US, that was the case. In China, that's sort of an extreme version of that. So there's a lot of pent-up demand sitting basically in bank accounts in China, which is one reason that we're actually quite positive on that space. If you get, and this is probably the next step of the discussion, you get the government action that starts to build that confidence back in, and really in I suppose one of the comments we'd make about financial markets and etc. is history does not repeat, but the saying is that it rhymes. You get a lot of similarities and in terms of the playbook. And I suppose if we look back to the US GFC, what happened there is ultimately you had the US government step in through various forms to support the banking system. And ultimately they had this program, the TARP, which was the Troubled Asset Relief Funding, I think it was, or program. And that ultimately took crappy assets off balance sheets and created confidence for the banking system. Those are the sort of actions that we've now started to see in China. Probably two key ones that they've taken is, again, I sort of touched on that, what people don't have faith in is, being able to buy a property that is, not yet started on the plans, maybe started but not going anywhere. You're not going to touch that. The Chinese government has, they've probably been taking a little bit of time with this, but it's been the speed and the intensity of this has been ramping up quite quickly in that, they have a number of programs. One is this sort of whitelist program where they've said to regional governments, you need to identify property projects that are on the plans or haven't been started that need to be finished. You identify them, you approve them, they will be funded by the government. It'll get it done. And the next step is they've actually said, it's likely that we have what they call the I think it's the third plenum coming up in a month or so, and that's sort of the meeting of effectively the cabinet meeting, I suppose, in many respects, strategy cabinet meeting. And there is an expectation there that they will essentially approve the direct buying of property effectively for affordable housing. To us, those are sort of the actions that underpin and stop the decline in confidence and starts to unleash potentially that enormous amount of, I think it's sort of somewhere in the region of $5 to $6 trillion of savings that sit within that economy, which are frankly not going anywhere at the moment. You start to unleash that, and you actually get, you get consumer spending, you get growth, you get demand for commodities. It becomes a virtuous cycle again.
Yeah. So they had a lot of supply coming online and excess housing, which was a function or to support urbanisation across China. And then that essentially went too far, didn't it?
Yeah.
And then the developers, they in turn struggled to sell everything, and they didn't look as strong anymore. And so investors ceased to be willing to take risk in buying those properties. And so now by the government stepping in, it de-risks it from an investor's perspective or from a home or apartment owner's perspective, and they can feel more confident about the future.
Yeah.
And you have that, correct me if I'm wrong, but it's, a part of it is this idea that if you feel like you've lost money on your home, for existing homeowners, you're much less willing to spend more generally. So that's the unleashing portion. Okay, do you think that that will mean then that the culture of investing in housing in China will kick off again, or is it going to result in a sort of a redeployment to consumption and perhaps investing in other productive assets like business and shares and private businesses?
Yeah. I think there's sort of three parts to the answer of that. One, yes, I think it will make people more willing to step up for those properties. So, that is a natural intent of that process. But again, if we go back to the reason that the government actually sort of put the brakes on that space is, in some respects, at a very big picture, if thinking about sort of the global tensions and etc., they want to ensure that China has the technology base, has the made in China, but of high quality products, high quality services. They need more of a domestic investment base to do that. So part of their reason for looking to put the brakes on the property space was also about shifting savings into financial markets, into the share market, things like that. And, we have spoken before about a number of, over the last couple of years or 4 or 5 years, they've made a number of changes that really, I suppose, sort of puts more of a framework that we would expect, a legal framework, looking to build investor confidence in companies in terms of, making sure that directors are liable for X sort of things and that there's, competition law, all of those sort of things are fully in place to, ultimately create more confidence in that space. So there is very much a desire to move and encourage share markets. And, I haven't touched on it, but as part of their, they've announced a number of incentives around the housing market. They've also announced a number of initiatives around shares, things like that.
So sort of governance and anti-corruption and...
Exactly, yeah. The other area, which comes back to the start of our discussion, is actually gold seems to be getting a lot of boost from ultimately retail China. We've talked before about, one of the, I suppose, one of the interesting outcomes of the Ukraine-Russia war is that, ultimately with that you had the freezing of Russian reserves by Western nations. And, that ultimately happened predominantly because they have control over the bank, SWIFT banking network. In terms of one of the outcomes of that was that a lot of other central banks traditionally hold their offshore reserves across a variety of currencies and assets, one of which is gold. I don't know, but I'm sure Reserve Bank here may hold some gold, for example, as historically. With that action, that concerted action by sort of Western groups to Western governments to freeze Russian reserves, you've seen central banks of Russia, of China, of other places increase their amount of gold they've been buying. And in terms of the annual amount that's produced, it's about, broadly central banks are buying about a third of all gold that's produced annually. So it's quite significant. Again, if you think about that process for that we've talked about in terms of the Chinese consumer, actually I'll go back a step. In terms of, and what was unusual about that process with post-Ukraine is actually interest rates were going higher. And usually that's a negative for gold. Interest rates going down, gold doesn't have or interest rates going up, vice versa. Because gold doesn't have a yield, doesn't generate any income, higher interest rates mean the opportunity cost is higher of holding it. Lower interest rates mean a lower opportunity cost and you're more likely to buy it. But because of that demand dynamic, it didn't happen. If we think about China, one, people have a lot of cash. Two, interest rates in China have been coming down. The economy is slow. So from that point of view, you have that incentive and people have been buying gold in China. So it's another aspect of where that demand comes from within that space. So, that's a position we've had at times in the portfolio, probably not to the same degree, but equally the demand-supply dynamics seem to, well, clearly gold supply generally is very low, but you have some strong demand dynamics at present. That's why it's at record prices.
Interesting. How, well, at the end of last year, you joined us for a discussion, and one of the things that was sort of a thematic at the time was that China was quote unquote uninvestable, and it wasn't something that we shared as such, but it was a perspective that seemed to be universally felt in financial markets. Now it feels.
I think many still think it's that
many
way.
still think it's that way, perhaps, but obviously we feel more strongly that it's becoming more investable, and I suppose that's an exciting time to be at least allocating a little bit of capital to that region.
Yeah, and again, I think, and we've talked about it a lot, but you go back to the famous Sir John Templeton quote, bull markets are born in pessimism. Yeah, ultimately, when people are not interested in talking about an asset or a subject, they just don't want to own it at any price. That's generally when the bottom is close in terms of markets. They're born of pessimism. Next step is they grow on skepticism, they mature on optimism, and then they die in euphoria. Yeah. And still very much think China is in that pessimistic space. And it's interesting, you've seen some markets, some of the share markets, especially the Chinese shares listed in Hong Kong, perform very well over the last sort of 2 or 3 months. A lot of that seems still to be those who are much closer to that market. The actual true international investor is still not there.
Okay, optimism. And we talk about optimism in the US and capital expenditure, and that was one of the themes to unpack a little bit. Why is it that US companies, or any company for that matter, but why is it that signs of capital expenditure is a signal for the future? And what are we seeing coming out of the US?
Yeah. Again, I might take it back to that sort of, that famous saying by Sir John Templeton. We've argued, especially on these calls earlier, that we still felt that we'd had ultimately global share markets had a good year last year, but there was still a lot of skepticism around, and people pointing to things like the wars, elections, etc., as reasons that markets wouldn't go higher. So far we've had outside of New Zealand, most global share markets have had a good year so far. We've had many of the world's major markets are at or very close to all-time highs, and have had performance sort of towards sort of double digits or actually in double digits already. So really that's been that process where we've gone through that skepticism, market's gone up, it's still gone up. If we look at the natural step, the next one is more of that optimism, the maturing on optimism. And if you sort of think and look at what has happened in terms of, say, probably the best example is the US and Europe. In terms of those economies, they had, certainly in the US, there was go back a year or so, there was almost 100% expectation the US economy was going to be in recession. A lot of corporates ultimately prepared for that. They'd seen interest rates go up a lot. They were expecting tough times, so they prepared for that. They weren't spending.
Laying off staff.
Yeah. They, tightened the belts, etc., etc. Europe, a little different. They had both at a consumer level and at a corporate level, really significant cost of living shock, mainly in the form of energy costs. I can't remember the numbers, but gas prices were up sort of almost 10x in some places. To the point where businesses were closing down because, frankly, it was just not economic anymore. That has relaxed. So you've basically seen, in many parts of the world, businesses either needed to tighten the belts or had to. And, generally that process in the US, the economy kept trucking along quite happily, didn't see a recession, or at least not yet. And in Europe, a lot of that price impact from energy has very much dissipated. So actually life's got a bit easier. And the next step about that is moving into, well, if demand's higher than I expected it to be for some of my products, am I able to produce those products? If I've laid off staff, might have to bring back staff. But equally, if I haven't spent on capital goods for the last 4 years, and there's been a lot of delayed spending, there's naturally stuff, if your car's 4 years older, you're probably more likely to get to the point where you need to replace it, especially if, that's about, if you're a courier driver or something like that, you need to go through that process and replace that. If your demand's higher, which it seems, you're seeing corporate earnings are positive, they're good. That demand's higher. That sort of builds people's optimism about the future. But equally, it sort of says, actually, I need to go and spend just to make sure that we can meet the demand that we're seeing. And that becomes ultimately a virtuous cycle. So, that's sort of why I use that John Templeton saying is, you start to get that optimism breeds more earnings, and that becomes positives. And we're seeing that, one thing we do watch are things called sort of PMI indices, purchasing manager indices. They tend to be essentially, the person who's actually buying goods for a business, that they tend to do that because why? They can see demand coming. Those PMI indices generally have become more positive in a fairly uniform way across places like sort of the US, Europe, Japan, and even to China to that extent. So for us, that says that that's more of a positive or another positive impulse that's coming. And the other one is also, if you think about, that's probably much more of a swing factor in terms of business spending than maybe consumer demand. Consumer demand, is a much larger part of economies, but is probably more stable. Whereas businesses really do have an ability to say yes or no and turn stuff off and turn stuff on. So that's one reason why we do think we've still got a positive runway for global shares.
Yeah, I guess with capital expenditure, ultimately, from a business perspective, they're investing in things like technology, factories, infrastructure that supports commerce. And the more that happens, it sets up the US economy or any economy for the next stage forward in growth. So if everyone pulls back, it gets felt everywhere, of course, but as investment picks up again, it's the bedrock of the next phase.
Yeah, and I think that is, especially in the US, that is the case, is because of sort of that mindset of COVID, because of the massive rise in interest rates, really sort of people said, there is this bad weather coming, we're going to have to hunker down. And actually, as it turned out, or at least at this point, you've continued, you haven't seen a recession in the US. You continue to see strong growth. So they've sort of prepared for the storm that didn't happen, and they've got to open everything up again.
It's amazing, isn't it, how you can have commentators the world over, I guess, screaming Chicken Little at one level, and then actually the numbers just don't support it at all. And employment stayed really strong in spite of higher interest rates. Savings continued to be high, in spite of apparently massive layoffs, and then in the end, the number, what was it, 2.3? I think was the year-end number for US growth, which is meaningfully higher than what most commentators would have said at the beginning of the year.
Yeah, and I think leading, I know you touched on it at the start about sort of the New Zealand economy. If you think about, especially in the US, and do a compare and contrast with New Zealand, does give us a little bit of cause for concern, because when in a more traditional cycle, probably like we're seeing here in New Zealand, in terms of the US, there was this preparing for something coming. They could see it coming. A more traditional cycle is you start to respond to pressures that you have, be it through interest rates, be it through lower demand. That's when you get layoffs. That's when you get capital expenditure cut. It becomes more a reactive rather than a preemptive action. And in the US, it was very much preemptive, but you ended up ultimately with, especially in the corporate space, very strong balance sheets. A lot of their debt, if they had it, was termed out to very long levels, so they're still paying 2% interest rates. They just didn't get the that cash flow wasn't squeezed to the same degree. I think here, as you come to New Zealand, that is the challenge we're seeing now, is that those consumer and corporate balance sheets are getting squeezed. They have high interest rates. Demand is low, and it's been low for a period of time. You have to start, in many respects, actually actively cutting costs rather than preemptively doing it. So you're responding, and that becomes slightly more self-fulfilling in a negative sense, unfortunately. So that certainly suggests that, I don't want to be too negative, but it suggests that we think you probably have a domestic economy that is more negative than the data suggests. The positive, if I want to take a positive, is that, again, especially things like share markets, are very good at incorporating what is known. And there is very clearly an expectation in New Zealand and an acknowledgement that economic activity is slow and has been slow for a long time. So from that point of view, it is increasingly in the price. That's one reason why the share market hasn't gone anywhere in 4 years. And it's one reason why a number of large companies are at basically their cyclical lows and lowest prices we've seen in many years. So that, whilst on one hand the economic outlook may not be positive, the fact that it's priced in is actually quite encouraging.
Yeah, I guess there's the mismatch between what looks attractive from an investor's perspective and what looks attractive from, when you observe a business generally and their ability to generate employment and taxes and all the other stuff that economic activity or commercial activity does. How do you think about immigration and what that's doing to how we understand the numbers in New Zealand? Because we've had record numbers of arrivals, and we've also had more recently record numbers of people leaving, but the net position is still significantly positive. What does that mean for when we look at the data, and how do you strip back and to understand what's underneath it really?
Yeah, well, I think the challenge there is, and again, maybe this is a bit like the discussion we had in terms of corporate expenditure. A lot of this migration, clearly, we needed, we had very tight labour market, and we needed to bring people in, and we changed the settings to do that. But equally, at the same point, there clearly has been a pent-up demand of migration, globally. We're not the only ones seeing this degree of high level of migration. Australia's seeing very high levels. The US also is seeing relatively high levels. I think they've added something like 1 million people to their labour force just from immigration over the last year or so. In that sense, that is challenging in terms of trying to, I suppose, certainly in terms of the Reserve Bank's situation, trying to manage and understand the economy. That increases demand. Definitely increases demand for general products, certainly increases demand for things like rental houses. And we are seeing, in Auckland, rental accommodation seems to be running at about a 4.5% inflation rate in terms of rents. So that's there, but at the same time, it kind of masks just a lack of activity underneath. Retail sales weren't too bad the other day, but generally they've been, over the last year, they're down sort of circa 7%. Once you take out that 2.5% from the increase in the population, those numbers start to get pretty negative on it, and certainly it means that the impact underneath on a per capita basis is much more negative. The challenge will come, I think, is as we see those numbers start to roll off. We've seen some changes in terms of the government look to tighten up on the settings, and naturally it feels like there is a little bit of that pent-up demand, and in time that is beginning to roll off now, and it might actually end up showing, or we would expect it ends up showing, an economy in terms of the numbers that is weaker. Basically the immigration helped to probably paper over some of the drop in demand, and you will actually see potentially some of these numbers actually fall back quite quickly in terms of demand and activity. which, again, sort of brings us to the Reserve Bank. The comments last week, they were steadfast in their view that actually inflation's still too high and they need to keep interest rates where they are. I've been much more positive that they would be coming down. I've been wrong in that point of view. But the longer this goes on and you get those dynamics, I think ultimately it creates more of an outcome where they can come down. And if you think about that analogy of a car sort of accelerating, coasting, or braking, from the Reserve Bank's view, and we'll take their numbers as sort of whether they're right, but we'll take them. Is that a neutral rate, whether a car would be coasting, whether they're neither adding to accelerating or neither braking the economy, is 2.75%, an OCR of 2.75. At the moment, it's 5.5. So we are a long way from a neutral rate. So from that point of view, I think that's worth people keeping in the back of their minds that the brakes are firmly on. As they come off, they might actually need to go, even just to get back to a coasting type scenario. We could see some material interest rate cuts over this next year or so.
So when they've made their decision that the numbers can support rates coming off, they can move down quickly.
Yeah,
is what you're saying.
And I think, sorry, the other point I was going to make is I thought it was interesting last week that the bank did point to, if we think about the process we've been through in terms of local inflation, they were concerned certainly around wage inflation, no concerns there. Certainly a lot of the cost pressures in the domestic economy and clearly things like building products, they're not, that inflation is not there, or it is, it's certainly diminished to a level that is much more normal. So a lot of those core things they were concerned about, they've been solved by the slow activity. It's really that sort of, the last point is that sort of non-tradables level. And many of those are, basically they're not impacted by interest rates. So they take a lot longer to roll out of the system.
Yeah, okay. Budget's coming up very soon, isn't it? Do you think the government is going to be able to move things quickly in terms of responding to the declining environment? And or do you think that their hands are tied?
What's the right way to put it? I think the best way to talk about that is, again, if we think in those sort of big picture terms, where does aggregate demand, where does our demand in our economy come from? It comes from two places. It comes from consumer spending, corporate spending, so being one and the same, and government spending. And if we go back sort of through that post-COVID period, it really was the government spending that kept things going. Even going back to last year, we still had a situation where government spending was accelerating. And ultimately that kept up household income higher than it probably would have otherwise been. Now you have a situation very much where the consumer is tightening the belt, the corporates are tightening the belt, and we now have a government that's tightening the belt. So from those sort of drivers of pressure, and especially the drivers of pressure on inflation, that's another reason where that braking is happening. I think you are going to see, and clearly, the government has signalled through job cuts and things like that they want to get spending down. That is something that, for the time being, definitely depresses the economy. Certainly will probably help with inflation coming down. And as an interesting, I suppose, comparison, if we look to places like the US, that's another reason why actually you have some of those green shoots happening, is you have a lot of spending going on. I think their budget deficit is still circa 5 to 6% of GDP. It's basically GDP in many respects, and they're spending on things like sort of the green transition and bringing production and activity back to the United States. That is another reason that creates that optimism there ultimately. So we're kind of lacking in that part.
Okay. In the portfolios that we manage that focus on New Zealand and Australia too, just give us a high level of how you think about managing the local risks and for our investors and the types of companies that you will see in those portfolios, and why the case for continuing to invest locally is still so strong.
Yeah, I think there's a number of reasons. One, at its simplest, even before we talk about the companies, New Zealand companies tend to pay a high dividend yield. So from that point of view, if you're looking for 8 to 10% per annum out of shares, and a company's paying you for 4% or more, that gets you at least 50% of your return target. So that is a positive. Two, given the structure of New Zealand shares and the taxation structure, is essentially investing in New Zealand shares are tax-free, especially given the imputation credit process. So from that point, that is a very it's a very strong reason to have a decent allocation in New Zealand.
So long as you're investing via a pie.
Correct. Yep. In terms of, second point would be in terms of if we think about companies, very much our process is, one, we want to work out, first question we ask the analysts is, will this company be here in 10 years? We're investing people's life savings. We want to make sure we buy high quality businesses. So that's, they need to go hand on heart. I know this business will be here in 10 years. And then it's very much a process about actually looking backwards rather than forwards. And we've spoken about this before, is sort of saying, well, what has this company earned in the past? In the good times, how much has it earned? In the bad times, how much has it earned? And equally, what has the market been willing to pay for that company during the good times and the bad times? We've talked about the sort of multiple approach where we look at a multiple of earnings. We might pay 10 times earnings. And if during the bad times, a company may trade on 6 times earnings, and during the good times, people may be willing to buy it for 12 times earnings. And at this point in time, a lot of what we're looking back at and looking at different businesses is saying, well, actually, their earnings are pretty close to some of the worst earnings we've seen over the last 10 years. But equally, the market's not demanding much from them. The market's saying, well, we're only going to value on 6 times earnings. So that to us says, if you sort of think about a box, we are at that bottom corner in many cases where actually there is not much optimism out there. People are saying, well, I'll just pay this. They're not actually building in good times. It's about sort of what's in the price. There's a lot of bad news in the price. Conversely, if we're at the other end of the spectrum, if you're paying record earnings and record multiples, that means there's very little fat. So at the moment, it does actually, we're looking through different positions, and it is very much you want to pick individual companies that have that, but we're definitely seeing that in New Zealand. Companies at very depressed prices, which are pretty interesting. Having said that, within our portfolios, they're very much Australian and New Zealand share portfolios, and we are more positive on Australia. We do think, that is a market that is better placed in terms of growth, also better placed in terms of China, in the sense of, if you think about, the New Zealand share market, very much it's focused on utilities and, industrial type businesses that are quite domestic focused. The New Zealand share market doesn't have a lot of exposure to the export sector. In Australia, you go to that market and, basically it's dominated by banks and resource companies. It's those resource companies that are very much levered to China and the activity in global commodities that we've talked about. So we think there is, in terms of the mix between Australia and New Zealand, we're at the highest mix to Australia that we've been in some time.
Righto. Okay, well, it's very clear what the investment approach is. Mark, thank you so much for joining us this morning. It's been a great conversation, some really interesting insights, and it's clear a lot of thinking has gone around how to build portfolios and how to manage the risks that I guess the world presents today for investors, including investors within NZ funds. Thank you everyone for joining, and we'll hope to see you again soon.
Thanks all.
New Zealand Funds Management Limited is the issuer of the NZ Funds Active Income Series, NZ Funds Active Inflation Series and NZ Funds Active Growth Series, together the NZ Funds Active Series, as well as the NZ Funds KiwiSaver Scheme, the NZ Funds Managed Superannuation Service, NZ Funds Wealth Builder and NZ Funds Income Generator. For further information or to request a copy of the product disclosure statement for each of these, please contact NZ Funds or visit nzfunds.co.nz. This recording is provided for information purposes only. The information provided is not intended as a substitute for specific professional advice on investments, financial planning or any other matter. Past performance is not an indication of future returns.